All right, quick check-in before you scroll. If you watch markets even casually, you need to hear this. Because something historic just happened, and it didn't unfold over months or weeks. It happened in hours. Silver just plunged 34% in a single day. 34. That's not a pullback. That's a trapdoor opening beneath your feet. And at the exact same time, nearly $1 trillion in gold value evaporated in less than 24 hours. Now here's the part most headlines are missing. The real trigger isn't panic selling, and it's not collapsing demand, it's structural, it's mechanical, and it's happening right now, while everyone's staring at the aftermath, wondering what just hit them. Stay with me, because I'm going to show you exactly how this works, how to spot it early next time, and why this move may actually be a warning signal, not an ending. If you're watching this now, you're already ahead of 90% of people who will spend the next week confused by surface-level explanations. Before I explain what caused this, let me teach you something most people don't understand about silver pricing. When you see a silver price on your screen, you're not actually looking at the price of silver. You're looking at the price of a promise, a paper promise. Think of it like airline tickets. If 10 people book seats for the same chair, the ticket price can move wildly even though the chair never goes anywhere. The chair's real. The claims on it, those are just contracts. In silver, most trading happens through futures contracts, not physical metal changing hands. These are agreements to buy or sell silver at a future date. And when those paper contracts dominate price discovery, you can get extreme moves that have almost nothing to do with real-world supply. That distinction matters right now, because what you're seeing isn't silver collapsing everywhere. It's silver collapsing in one specific arena, the paper arena. While the physical market, that's telling a completely different story. So, what does that tell us? It tells us we need to separate signal from noise. The price you see flashing on CNBC is predominantly determined by COMEX futures trading in New York. That's where the leverage lives. That's where the paper dominates. And that's where this collapse originated. Now, here's what's actually happening. In US futures markets like COMEX, silver trades almost entirely as paper contracts. For every ounce of physical silver that could theoretically be delivered, there are estimates of 300 to 350 paper claims stacked on top of it. 300 to 1. Let that sink in for a second. That means large institutions don't need physical metal to move the price. They just need capital and leverage. They can sell contracts they don't have metal to back. They can buy exposure they'll never take delivery on. It's a price discovery mechanism built on leverage, not scarcity. So, when silver surged over 60% in January and turned into a crowded momentum trade, funds piled in, leverage piled up, and the setup became fragile. Really fragile. Then comes the trigger, aggressive contract selling, not because supply suddenly appeared out of nowhere, not because industrial demand collapsed overnight, but because unwinding paper positions is fast, it's brutal, and it's contagious. So, when selling starts, margin calls kick in. Traders have to sell to cover their positions. They don't get a choice. Prices drop faster. More stops get hit. More forced selling follows. That's the cascade. It feeds on itself. And here's what's wild about this. What should make you stop and pay very close attention? While paper silver was collapsing to the low 90s, physical silver in Shanghai was trading closer to 120, even 130 in some transactions. That's a 40% premium at the same moment in time. Two prices, one metal, same asset, completely different valuations depending on whether you're buying a contract or buying actual metal you can hold. That divergence isn't noise. That's stress in the system. That's the market screaming that something's broken in the price discovery process. And here's the part that should make you nervous, or at least very alert. When paper prices fall but physical premiums stay elevated, it means the sell-off didn't actually solve the underlying scarcity. It just reset the paper positioning. But here's what very few people are talking about right now. This isn't just about one market freaking out. Gold moved in tandem. Nearly $1 trillion in value, gone. And when you see precious metals moving together like that, synchronized and violent, you're not looking at fundamental reassessment. You're looking at liquidation. You're looking at forced selling across correlated positions. Think about what happens when a large fund holds both gold and silver with leverage. When one position hits margin requirements, they don't just sell that one. They sell everything liquid to raise cash. Gold gets sold. Silver gets sold. Treasury positions get unwound. It becomes a liquidity event, not a valuation event. The assets didn't suddenly become worth less. The holders suddenly needed cash immediately. And that's the convergence proof. You've got paper dominance in silver. You've got leverage across precious metals. You've got a parabolic move that attracted momentum traders. Then you get a sharp reversal that triggers margin calls, which triggers more selling, which triggers more margin calls. It's mechanical. It's systematic. And it plays out the exact same way every single time these conditions align. This is the exact same playbook we've seen before. Go back to 2011. Silver went parabolic, hit nearly $50 an ounce, sentiment went euphoric, everyone and their cousin was buying silver eagles, and leverage exploded. And then paper markets slammed it down in days. I mean days. It wasn't a gentle correction, it was a trapdoor just like this. Or look at 2020, when physical silver vanished from dealers even as futures prices whipsawed violently. You couldn't buy physical silver rounds at any reasonable premium. Dealers were back-ordered for months. But the futures price? That was all over the place, disconnected from the physical reality on the ground. Every time this happens, it follows the same rhythm. Rapid upside attracts leverage. Paper markets stretch far beyond physical reality. Then, a sharp correction resets positioning without fixing supply. The paper gets flushed. The physical stays tight. And 6 months later, everyone's surprised when it happens again. What happened next in those cases? Well, in 2011, silver bottomed around $14 about 2 years later, then spent years consolidating. But the fundamental supply issues never went away. In 2020, after the initial chaos, silver rallied from $15 to nearly $30 within months once the liquidation cleared. Same pattern we're seeing today. Zoom out, and you see the larger story isn't about one bad day. It's about repeated pressure points where price discovery breaks down under its own weight. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this just be a normal blow-off top? Absolutely. Could some of the manipulation talk be exaggerated? Sure. Markets don't need villains to move fast. They just need leverage and fear. Human psychology plus margin requirements equals violent moves. You don't need conspiracy theories to explain that. Could the fundamentals have actually changed? Could industrial demand be softening? Could central banks be shifting away from precious metals? Maybe. Those are real questions worth asking. The mistake is obsessing over intent instead of mechanics. You can spend all day arguing whether big players deliberately crash the market, or you can focus on recognizing when a market is dominated by paper claims instead of physical reality. I can't control whether institutions sell contracts. You can't control geopolitical narratives, but you can control whether you recognize structural fragility when you see it. Focus on structure, not narratives. That's where your edge lives. That's what lets you stay rational when everyone else is either panicking or making up stories. There are probably 3 types of people watching this right now. First, there's you if you're holding silver and feeling shaken. Maybe you bought in at 110, 115. Maybe you've been stacking for years and just watched your position get hammered. That's normal. Volatility like this rattles everyone. I don't care how experienced you are. A 34% single-day drop makes your stomach turn. Your job isn't to react emotionally. It's to ask whether the reason you own silver has actually changed. Did industrial demand disappear? Did solar panel production stop? Did the supply deficit reverse overnight? Or did a leveraged paper market flush out weak hands? Those are very different scenarios. If you bought silver because you believed in long-term supply constraints and monetary uncertainty, ask yourself if those conditions changed yesterday. If they didn't, then you're watching price volatility, not fundamental deterioration. Doesn't mean you hold blindly, it means you evaluate based on your original thesis, not based on fear. Second, there's you if you missed the run-up and think you dodged a bullet. Maybe you watched silver climb and felt like you were late. Maybe you're relieved you stayed out, and you might be right. But understand what you avoided wasn't silver risk, it was leverage risk. That distinction matters for timing. The people who got destroyed weren't the ones who bought physical metal and held it. It was the ones who bought leverage futures, who traded options with tight stops, who used margin they couldn't afford to lose. If you're thinking about entering now, you're potentially looking at a much cleaner setup than 2 weeks ago. The leverage got flushed, the weak hands are out. The physical premium tells you demand didn't evaporate, but you need to be honest about your time frame and your risk tolerance. Don't chase just because it dropped. Have a plan. Third, there's you if you're just trying to learn how markets really work. If you're here to understand mechanics, not to get rich quick, this is your case study. Paper dominance, leverage, forced selling, divergence between paper and physical. You'll see this pattern again in other assets, guaranteed. Different names, same mechanics, could be uranium, could be lithium, could be another commodity that goes parabolic on a supply story and then gets hammered when paper contracts unwind. The principle is universal. When paper claims vastly outnumber physical assets, and when leverage enters the equation, you get explosive moves in both directions. Learning to recognize that setup is worth more than any single trade. So here's what I want you to answer in the comments. Which type are you? Are you holding and reassessing? Are you watching for entry? Or are you here to learn the patterns? Tell me where you're at. Here's where I stand. I'm not euphoric and I'm not bearish. I'm alert. First, I'm watching physical premiums. If they stay elevated over the next week or two, that tells you demand didn't break. It tells you the paper market disconnected from physical reality. And that divergence usually resolves upward eventually, not downward. If premiums collapse back to normal, then maybe this was actual demand destruction. Second, I'm watching paper positioning. A reset can clear the runway. When leverage longs get flushed out, when margin requirements force weak hands to exit, you often get a cleaner technical setup afterward. That doesn't mean it rallies immediately. It means the next move up, if it comes, has less overhead resistance. Third, I'm monitoring how gold and silver decouple or reconnect after this shock. If gold stabilizes while silver stays volatile, that tells you silver's move was more technical than fundamental. If they move together again, that suggests broader precious metals dynamics are still in play. Based on my analysis, this drop was mechanical, not emotional, structural, not random. The fundamentals didn't vanish in a day. Central banks are still buying gold. Industrial silver demand for solar and electronics hasn't disappeared. Supply deficits don't reverse because futures traders sold contracts. What changed was positioning, not reality. And if history rhymes, these stress events don't end cycles, they reshape them. They flush out the weak hands and create the conditions for the next leg. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the Shanghai premium data yourself. Look at historical COMEX positioning reports. Don't take my word for anything. Your capital, your decisions. But if you made it this far, you're the kind of person who thinks critically instead of reacting emotionally. That mentality will serve you well, whether you're in silver, in stocks, in crypto, or just trying to understand how markets actually function beneath the headlines. If this breakdown helped you see the mechanics more clearly, share it with someone who's confused right now. Subscribe if you want more pattern recognition and less hype. Stay sharp out there, think critically, verify the data, and make your own decisions.